They want you to believe the crash was natural. Profit-taking, speculative blow-off, Chinese traders getting margin called. U.S. Treasury Secretary Scott Bessent went on record blaming the whole thing on speculation. Media parroted the same lines. Silver rallied too fast, too high, too frothy. Had to come down. And on January 30th, 2026, they executed one of the most violent single-day crashes in commodity history. Silver had reached an all-time high of 121.78 per ounce on January 29th. The next day, it collapsed to an intraday low of 74, a 39% drop in a single session. Nearly $48 per ounce erased in hours, the biggest one-day destruction in modern silver market history. But here is what they are not showing you in the headlines. Here is what the vault data reveals that makes the entire narrative fall apart. In 1980, when silver hit $50 per ounce, COMEX had 220 million ounces in registered inventory. Today, with silver at around $82, after bouncing from that $74 crash low, COMEX has 82 million ounces. That is 63% less inventory supporting a price that is 70% higher than the 1980 peak. And industrial demand has not just increased, it has tripled. Solar panels need silver, electric vehicles need silver, AI data centers need silver, 5G infrastructure needs silver, medical devices need silver. Every technology driving the modern economy runs on silver. And there is less metal available today to satisfy that demand than there was 46 years ago when demand was primarily investment-driven. The crash was not about fundamentals. It was about hiding a supply crisis that is about to break the entire pricing system. Let me show you the numbers they do not want you to see. It is February 11th, 2026. Silver is trading around $82 per ounce, down from that 121.78 peak on January 29th, up from the panic low of $74 on January 30th. The media calls it a correction, a healthy pullback after excessive speculation. But look at what happened to the price over the last year. 1 year ago, silver was around $32 per ounce. Today, even after the most violent single-day crash in commodity market history, it is $82. That is a 156% gain in 12 months. The crash brought silver from $121 to $74 in one session. Then it bounced back to $82 where it trades now. But that is still more than double where it started 2025, still triple the 2024 price. So why did the sell-off happen then? Why trigger the most aggressive margin hikes in history and force mass liquidations if the rally was driven by real structural demand? Because the vault situation is worse than 1980, far worse. And they needed to shake out every single leveraged long position before the delivery crisis in March exposed how little physical metal actually exists in the system. COMEX registered inventory has been collapsing since 2020, from a peak of 346 million ounces down to 82 million today. A 76% drop in available deliverable inventory, while industrial demand exploded across every sector. In the same time period, solar panel manufacturing grew from consuming around 100 million ounces per year to over 300 million ounces annually. Electric vehicle production tripled globally. AI infrastructure went from zero silver demand to consuming tens of millions of ounces for server racks, cooling systems, and data center buildouts. The demand curve went vertical, and the supply available to satisfy that surging demand dropped by 3/4. Now compare that to what actually happened in 1980. When silver hit $50 in January 1980, COMEX had 220 million ounces sitting in registered vaults. The metal was there, available for delivery. The Hunt brothers were trying to corner the market. Nelson Bunker Hunt and William Herbert Hunt accumulated around 200 million ounces through futures contracts and physical purchases, massive coordinated speculative buying. But there was no real underlying industrial demand driving the price rally. Just two billionaires and their partners trying to monopolize global supply and force a short squeeze. And CME responded by creating Silver Rule 7 out of thin air. Changed the rules of the game overnight. Banned leveraged buying completely. Only cash purchases allowed. Raised margins 5 times in 9 days. Made it economically impossible for anyone to hold long positions. Forced cash settlement on contracts that wanted physical delivery. Crushed the price from $50 to $10 over the following months. An 80% collapse. The biggest destruction in silver history until January 30th, 2026. The system survived the 1980 crash because demand was completely artificial. Once the Hunt brothers got margin called and their massive positions were forcibly liquidated, demand disappeared entirely. Industrial users were not lining up to buy silver at $40 or $30 or about $20. Jewelry demand was discretionary and collapsed along with the price. Investment demand evaporated as retail got wiped out. The rally was pure speculation driven by two individuals. Remove the Hunt brothers and demand vanished. The price collapsed back to fundamental supply and demand levels. The market stabilized. COMEX refilled its vaults over time as miners increased production. Life went on. The system survived. But 2026 is not 1980. The demand driving silver prices today is not speculative. It is structural, permanent, industrial, non-negotiable, and completely independent of any individual buyers or speculative positioning. Samsung just announced solid-state battery technology that requires 1 kilogram of silver per 100 kilowatt-hour battery pack. That is 20 times more silver than current lithium-ion battery technology. If solid-state batteries capture just 20% of the global electric vehicle market by 2030, that alone creates 514 million ounces of new annual demand. That number is larger than current total global industrial consumption from all sources combined, just from one technology, one application, one sector of the economy. And that does not include the massive solar panel build-out happening across the world, the 5G infrastructure expansion requiring millions of new cell towers and relay stations, the AI data center boom requiring millions of servers with silver-based components, the defense industry spending on advanced missile guidance systems and radar technology, the medical device manufacturing for X-ray machines and diagnostic equipment, the water purification systems being deployed globally. All of those industries need silver, and there is no commercial substitute that works at scale and competitive cost. In 1980, you could replace silver in most of its applications without major economic consequences. Photography was the biggest single industrial use of silver, and that entire industry disappeared with the advent of digital cameras. Jewelry demand was discretionary consumer spending that could be deferred. Investment demand could simply walk away when the price collapsed. But today, you cannot build a solar panel without silver paste for the photovoltaic cells that convert sunlight to electricity. You cannot manufacture an electric vehicle battery management system without silver contacts and connectors. You cannot produce advanced semiconductors without silver bonding wire. The metal is embedded into the fundamental supply chain of every critical industry in the global economy. Remove silver from the system and production stops immediately. Factories shut down, supply chains break, economic growth halts, national security capabilities get compromised. That is why China reclassified silver as a strategic material on January 1st, 2026. Same export control category as rare earth elements and other materials deemed critical to national security. Licensing requirements imposed, export restrictions implemented. Only 44 approved companies can now export silver from China, down from over 100 companies previously. China is the second largest refiner of silver in the world. And they just cut off global access to that supply. They are hoarding domestically, prioritizing their own solar panel production capacity, their own electric vehicle manufacturing, their own electronics industry, their own strategic reserves for future industrial needs. The West cannot access Chinese refined silver anymore. The global supply chain just lost access to a major source. And COMEX vaults are sitting at 1980 inventory levels of 82 million ounces, while global industrial demand is triple what it was in 1980, triple the consumption, 63% less available inventory, and prices 64% higher than the 1980 peak, even after the crash. Now let me show you exactly what happened in January that made the banks realize they had to crash the market before it was too late. Between early January and mid-January, in just 7 trading days, 33 million ounces were withdrawn from COMEX vaults for physical delivery. That is 40% of current registered inventory gone in 1 week, 40% in 7 business days. On January 7th alone, JP Morgan issued delivery notices for over 8 million ounces. 99% of that single day's total deliveries came from one bank. JP Morgan was delivering metal to settle contracts. But here's the part that should have made every financial headline but got completely buried. Despite 1,624 contracts being delivered and closed on January 7th, open interest for January contracts actually increased by 1,431 contracts that same day. That is mathematically bizarre and should not happen in normal market conditions. Deliveries should reduce open interest because contracts get settled and closed out of the system. But new buyers were entering January contracts after deliveries had already started. They were rolling backward from March into January, moving their positions from future months into near-term expiration, paying premiums to get earlier settlement dates, demanding metal immediately instead of waiting for the traditional March delivery period. That behavior signals one thing clearly: panic among sophisticated buyers. It signals institutional players who do not trust that metal will be available if they wait for March delivery. Buyers who have inside knowledge about the vault situation that the general public does not have access to. And when January delivery rates hit over 80%, when February delivery rates exploded to 98%, the banks and clearing members ran their projections on March and realized they were facing a catastrophic delivery crisis. March is historically the single largest delivery month for silver futures. Between 30% and 40% of total annual physical deliveries happen during March contracts. If March followed the same delivery pattern as January and February, if delivery rates stayed elevated at 80% to 98%, COMEX could potentially face demands for 200 to 300 million ounces against available registered inventory of only 82 million ounces. The system would break completely. The fractional reserve structure would be exposed publicly. The confidence game would end in spectacular fashion. So they crashed it. They crashed it hard and fast to create maximum fear. Look at the exact timeline of events, and you will see the coordination. January 23rd, silver breaks through $100 per ounce for the first time in recorded history. Psychological barrier shattered. Mainstream media coverage explodes. Retail FOMO kicks in across social media. January 26th, gold breaks through $5,000 per ounce. Precious metals are in a full parabolic rally. Momentum everywhere across the sector. January 29th, silver hits 121.78, new all-time high. Record price that exceeded even the inflation-adjusted 1980 peak. Then January 30th at 6 a.m. Eastern Time. Before markets even open, President Trump announces Kevin Warsh as his nominee for the next Federal Reserve Chairman to replace Jerome Powell when his term expires. Kevin Warsh is a known monetary hawk, strong dollar advocate, anti-inflation hardliner, supporter of higher for longer interest rate policy. The macro narrative flips overnight in an instant. Dollar index strengthens immediately. Treasury yields spike on expectations of sustained high rates. And within hours of markets opening for trading, CME Group announces emergency margin requirement increases. Initial margin requirements for silver futures raised 18% effective immediately at market open. Then another round of increases announced for implementation over the weekend. Then yet another round scheduled for the following week. By February 2nd, total margin requirements had increased 36% in just 4 days. Traders holding long positions suddenly needed 36% more cash posted in their accounts, or they would face immediate forced liquidation of their positions. Leveraged hedge funds got margin calls. Family offices managing billions got margin calls. Retail traders holding futures contracts got completely wiped out. Algorithmic trading systems detected the massive forced selling and triggered cascade stop-loss orders across the entire complex. Liquidation feeding more liquidation. The price collapsed from $121.78 to $74 in a single session. Over $47 per ounce erased in approximately 6 hours of trading. A 39% destruction in one day. Then it bounced back to around $82, where it currently trades as of February 11th. The mainstream financial media called it profit-taking after excessive gains, speculative excess being wrung out of the market. Treasury Secretary Scott Bessent publicly blamed Chinese traders for creating a speculative blow-off. But the vault data tells a completely different story. And this is the critical part that proves the crash was manufactured. Because while silver was crashing 39% in the paper futures market, physical premiums were simultaneously exploding in the opposite direction. Coin dealers across America were selling American silver eagles for $120 to $150 per ounce. Generic silver rounds were selling for $110 to $130 per ounce. Physical premiums of 50% to 80% over the crashed COMEX spot price. Think about what that means. If the crash on January 30th was real selling driven by collapsing demand, if industrial buyers were actually dumping inventory, if end users were canceling orders, physical premiums would compress toward zero. Physical metal would trade at a discount to paper futures as supply flooded the retail market. But the exact opposite happened in real time. Physical premiums exploded to all-time record highs, while the paper price crashed to $74. Physical metal was trading 60% to 100% higher than paper futures at the absolute bottom of the crash. That tells you everything you need to know about what actually happened. The crash was not about supply and demand fundamentals in the physical metal market. It was purely about margin-driven forced liquidation of leveraged long positions in the paper futures market. The paper market crashed violently. The physical market went into extreme shortage mode simultaneously. And the backwardation in the futures curve confirmed the physical shortage in real time. In normal commodity markets under normal conditions, futures contracts trade above spot prices because holding physical metal has real costs. Storage facilities, insurance policies, financing charges, opportunity cost of capital. March futures should trade at a premium to spot prices. But after the January 30th crash, spot prices were trading higher than March futures. The market went into backwardation. That condition only happens when physical demand is so urgent and desperate that buyers will pay more to get metal delivered today than to get metal delivered in 2 months. When the spot market knows something that the futures market refuses to acknowledge. When physical shortage meets paper abundance. The lease rates spiked to confirm the exact same shortage signal. In October 2025, silver lease rates hit 34% annualized. Some intraday peaks reached as high as 39%. That is the interest rate someone is willing to pay to borrow physical silver for short-term delivery needs. When lease rates spike to 34% or 39%, it means someone desperately needs metal for immediate settlement and cannot find available supply at any reasonable price. They are bidding up the cost to rent silver because outright purchasing is completely impossible. There is simply no inventory available for sale. The physical market was screaming shortage at maximum volume, while the paper price crashed and the media said everything was fine and normal. And the crash made the fundamental disconnect even worse instead of better. Now pay very close attention because this is where the comparison to 1980 completely breaks down and the situation becomes far more dangerous. In 1980, after the crash from $50 down to $10, industrial demand for silver did not accelerate. It actually stayed relatively flat for years afterward. Photography demand eventually disappeared entirely when digital camera technology took over the consumer market. Jewelry demand was cyclical based on economic conditions and collapsed along with the price. Investment demand evaporated completely after retail investors got burned badly. Silver traded sideways in a brutal range for 2 full decades because there was no structural reason for the price to recover quickly. The Hunt brothers were gone and bankrupt. Speculative fever was completely dead. Industrial applications were either replaceable with substitutes or declining in total volume. The market had plenty of time to heal slowly. COMEX had time to refill vaults gradually as mining production increased. But in 2026, the crash on January 30th from $121 to $74 did not stop industrial demand. Not even for a single day. Solar panel manufacturing orders did not cancel. Electric vehicle production lines did not halt or slow down. AI data center construction projects did not pause. Electronics manufacturers did not suddenly find substitute materials. Samsung did not abandon solid-state battery development programs. The structural industrial demand that originally drove silver from 32 all the way up to 121 is still there, still growing month over month, still consuming over 300 million ounces per year in solar panel applications alone. And Samsung solid-state batteries could potentially add another 514 million ounces of brand new annual demand by 2030 if they achieve even just 20% market penetration in the global EV market. That would nearly double current total industrial consumption from one single technology application. The demand is not going away. It is accelerating across multiple sectors simultaneously. But the supply available to meet that surging demand just dropped 76% since 2020. COMEX registered inventory fell from 346 million ounces to 82 million ounces today. They physically cannot refill the vaults fast enough. China permanently cut off exports with strategic material designation. Mining production is structurally inelastic because 70% to 80% of all silver production comes as a byproduct of copper, zinc, and lead mining operations. Higher silver prices alone do not directly incentivize significantly more silver production if the underlying economics of copper and zinc mining do not support opening expensive new mines. Primary silver-focused mines account for only 20% to 25% of total global output. And those dedicated silver mines cannot scale up production capacity fast enough to replace the massive inventory drain happening in real time. The fundamental math is completely broken. 5 consecutive years of structural supply deficits totaling over 800 million ounces consumed from global stockpiles. That represents nearly 1 full year of total global mine production drawn down from above-ground inventories. And the annual deficits are getting progressively worse each year as industrial demand accelerates. And here is what makes February 11th, 2026 fundamentally different from any other moment in the entire history of silver markets. COMEX has less registered inventory available for immediate physical delivery today than it had at any single point during the entire 1980 price spike when silver hit 50. Today, COMEX has exactly 82 million ounces in registered vaults. In January 1980, when prices peaked at $50, they had 220 million ounces available. That is 63% less physical inventory available today. But the current price, even after the devastating crash, is still $82 per ounce. That is 64% higher than the 1980 peak price of $50. And industrial demand for silver is triple what it was back in 1980. Let that mathematical reality sink in for a moment. Less inventory, higher price, triple the structural demand. The only reason the paper futures price is still $82 per ounce instead of $200 or $300 per ounce is because the vast majority of futures contracts settle in cash without any physical delivery occurring. Most traders and speculators never ask for actual metal. They just want price exposure for financial gain. The system has operated successfully for decades on the fundamental assumption that physical delivery demand stays well below 20% of total open interest. But January completely shattered that core assumption, with delivery rates exceeding 80%. February utterly destroyed it with 98% delivery rates. The fractional reserve assumption that underlies the entire futures market structure is now broken. And if March follows the exact same pattern, if industrial buyers continue demanding physical settlement instead of accepting cash, if Samsung and Tesla and solar panel manufacturers refuse to take paper dollars instead of actual metal for their production needs, COMEX faces an impossible choice with no good options. They can deliver everything currently sitting in their vaults and then publicly admit they are short by 100 million ounces or more and cannot fulfill remaining contracts. Or they can invoke emergency regulatory powers, exactly like they did in 1980, and force cash settlement on all contracts, regardless of buyer preference. But here is the critical difference that changes everything. Unlike 1980, forcing cash settlement in 2026 will not kill underlying demand. It will not make the problem disappear. It will simply move that massive demand somewhere else entirely. Buyers will go to Shanghai Futures Exchange, London Metal Exchange, negotiate over-the-counter private deals directly with mining companies, establish bilateral long-term supply agreements. The industrial manufacturers will get their required metal one way or another because their production depends on it. They will simply stop using COMEX for price discovery and hedging. And when COMEX loses its decades-long monopoly as the global benchmark for silver pricing, the paper futures price becomes completely irrelevant to the real physical market. Only physical delivery markets will matter, and physical is already trading at $120 to $150 ours, while paper says $82. That $40 to $68 gap is not temporary noise. It is not a short-term dislocation that will correct itself. It is the market screaming at maximum volume that the entire pricing system is fundamentally broken. That confidence in paper delivery promises is collapsing in real time. That the fractional reserve game that has worked for 50 years is finally ending. They crashed silver 39% in one single day to hide the vault crisis from public view, to terrorize and eliminate every leveraged long position, to shake out every speculator before March 27th when delivery intentions must be officially declared, to reduce total open interest and minimize the size of the coming delivery squeeze. But the crash did not change any of the underlying fundamentals. Registered inventory is still stuck at 1980 levels of just 82 million ounces. Industrial demand is still triple what it was back in 1980. Structural supply deficits are still draining approximately 200 million ounces per year from global above-ground stockpiles. China is still hoarding and has permanently cut off exports. Samsung is still actively developing batteries that require 1 kilogram of silver per 100 kilowatt-hour pack. Solar panel installations are still projected to consume 400 million ounces annually by 2030. The demand is permanent and growing exponentially. The supply is vanishing rapidly. And the January 30th crash from $121 to $74 was nothing more than a desperate attempt to buy a few weeks of time before the physical delivery crisis exposes publicly how broken the entire system actually is. In 1980, the crash from 50 down to 10 ended the silver rally permanently because underlying demand was purely speculative and completely artificial. Remove the Hunt brothers from the equation and demand disappeared entirely. But in 2026, the crash from $121 to $74 is already failing to kill the rally because demand is structural and industrial and absolutely permanent. And when the physical market finally breaks free completely from the paper price, when manufacturers start paying $150 or $200 or whatever price is required to secure supply for their critical production lines, when COMEX is forced to publicly admit they cannot deliver against March contracts, the global pricing benchmark will shift permanently. Price discovery will move entirely to physical delivery markets where actual metal changes hands, and the paper futures price will become nothing more than a historical artifact, a reminder of the era when silver traded like a financial instrument for speculation instead of being recognized as a strategic industrial material that is critical to national security and economic survival. The crash was not the end of the rally. It was the last desperate act of a broken system desperately trying to maintain control over a market it no longer understands and can no longer effectively manipulate.